Okay, so today we're going to be discussing Revenue Procedure 2024-28. I want this to be an AMA format, so I have some questions I've compiled from people, but also happy to take questions from anyone that's viewing. You can drop them into the chat here, and I should be able to see them and respond to them. I don't think there's a way for you to come on stage to ask the question though, but I mean, if there is, feel free to try to attempt to do that as well. I'll give it a minute or two to let some more people cycle in here, and then we'll get started. We'll give it about another minute, and then we'll get started here. Okay, so I think we can get started now. So again, I want this to be an AMA format. I have some pre-written questions that I've compiled through some, conversations with people and people commenting on some of my previous posts. So I'll start with some of those. There is the comment section here for the live, and you can drop your questions into there. I'm watching that on my phone, so I can reply to the questions as they come up, and I'm happy to answer anything related to this revenue procedure. So to get started, one of the first questions I usually get when I'm discussing this revenue procedure is, what is the purpose of it? Why are we even having to go through this process? And it is important to understand this. And, the reasons why we're having this revenue procedure that's requiring this accounting change from universal to account-based is for two main reasons. The first reason is that the 1099 DAs are going to start being filed with the IRS by entities that are defined as brokers starting in 2025. So that means like each exchange that you go to is going to be separately reporting your activity to the IRS. Obviously, that is going to be calculated on an account basis just by the fact that each separate exchange, aka each separate account, is going to be filing separately. So that's really the first purpose of this revenue procedure, is to shift from universal to account-based. So the accounting that you're doing as a taxpayer is aligned with the 1099 DAs and all this third-party reporting that's going to be going to the IRS. So that's the first reason. The second reason is that for years, people have been incorrectly applying accounting methods on a universal basis. And, one thing I'm proud to point out is that this is something that we have advised against to our clients at Camuso CPA, because we were able to see the inherent issues that come from applying some of these accounting methods on a universal basis. So to give you an example, a lot of people on a universal basis were using HIFA. And what this can lead to overall is inaccurate audit trails. Picture a scenario where you're doing a calculation on a universal basis and you're selling Ethereum on Coinbase, but the highest cost Ethereum that you own is on, let's say, Binance. The accounting, if you're following a universal basis, it's going to apply that highest cost to the sale on Coinbase, even if you didn't transfer that asset from Binance to Coinbase. So it's just creating completely inaccurate audit trails. And in the IRS's view, it leads to abusive tax practices because people are creating inaccurate audit trails and applying accounting methods sometimes years after the transactions have taken place. So going forward, this is not going to be permitted anymore. And the way that they accomplish that is through the account-based reporting and then some requirements regarding standing orders that we'll get into. So really, those are the two main reasons that I would give as to why we're dealing with this revenue procedure: to sync records with brokers and to stop abusive tax practices related to, certain accounting methodologies that are applied on a universal basis. So, another question I get a lot is, what is the difference between universal and account-based accounting? And maybe it would have been good to hit this question first, but let's go over it now briefly. So we're shifting from universal to account-based. So in the past, if you've been doing your accounting, or if your CPA has been doing your accounting, likely it's been done on a universal basis. What a universal basis means is that if you have 10 different wallets that all have Ethereum in it, you'll import all of those wallets and you'll apply an accounting method to just the asset Ethereum, irrespective of where it's being held. On an account-based tracking method, you're going to apply an accounting method to Ethereum, but you're going to apply it separately to each place where it's being held. So you'll apply your accounting method to wallet A, and then separately to wallet B, and then separately to wallet C. So you're looking at it on an account basis as well as an asset basis, whereas universal, you're just looking on it on an asset by asset basis. So, the account based does require somewhat more of an administrative burden, but it also offers the potential to optimize your taxes, because you're going to have cost basis that's assigned to specific wallets and accounts depending on where you're holding your assets. And then once those costs are assigned, you get to have the opportunity to be more strategic about where you're spending your assets from. You may have wallet A with a very low cost Ethereum allocated to it and wallet B with a higher cost Ethereum allocated to it. If you want to sell one of those, a little foresight and keeping your accounting updated can put you in a much better tax position, where you realize, let me transfer the Ethereum from wallet B rather than transferring the Ethereum from wallet A to take advantage of that higher cost. Now, on the universal basis, that all didn't really matter because you're just applying the accounting method on an asset by asset basis, and then applying whatever accounting method that may be. So that's where a lot of people were using HIFO and just optimizing things irrespective of their actual flow of funds on chain. So the next question I get from a lot of people is, what is the timeline that we have to complete this? Because I've been warning people about this now since like early July, because this revenue procedure came out late June. And a lot of times the overall perspective, I think a lot of times it's like, let me just wait till tax season, I'm not going to worry about it now. I have more important things to do with year end approaching and everything. But there's a January 1st deadline regarding this revenue procedure. So it is important for everyone, given we only have a couple weeks left, and some of that is going to be monopolized by holiday activity. So there's not much time left to really start taking care of this, but it's imperative from a tax perspective that you do it. So the January 1st deadline is the big overarching deadline, and that's what I really want to stress to people. When you really get down to the details, there are some exceptions to that and ways that we can kind of extend that if we're taking the right steps before January 1st. There's basically two potential steps to documenting the changes that you're making for the revenue procedure, and then there's an allocation process that has to be done. So from a documentation standpoint, you need to first document the allocation process that you're going to use, because there's a few permitted allocation methodologies that you can use for the revenue procedure to allocate your basis from your calculated universal basis, and then allocating those costs to each respective account where the assets are actually held. So you need to document the allocation method, and then depending on the accounting method that you choose, you will need to document standing orders as well in non-custodial wallets and with your brokers. So those two steps to documenting need to be done by January 1st without exception. Where there is more leeway is that if you take those steps to documenting everything appropriately before January 1st and you need more time to actually do the allocations need to be completed by the later of when you by January 1st when you file your tax return, or when you first trade those assets in 2025. So we're still taking in new clients that are realizing they need to do this revenue procedure. And one thing that I see a ton, and it's no exception now, is that most people's accounting is not up to date. There's groups of people where they've just never done their crypto accounting, and they're coming to us and they're like, hey, I have to do my crypto accounting from 2015 till now. There's other groups where they have done it, but it's been done inaccurately, either by them or a firm they used. There's others where they have done it, but they don't have all of their cost basis information. They didn't retain the appropriate data that they need. So, all these groups of people basically need to go back and rework a lot of their accounting. And that's where the bottleneck comes in with this, because if you're going to do the allocations from universal to account based, you need to have an accurate basis. That's our first starting point, is let's take a snapshot of your accurately calculated universal basis, and then snapshot your actual accounts, and then, start the allocation. So that's the first bottleneck, is we have to get your accounting done. So that's where this timing comes in for people. If you need to do multiple years of your accounting, or even if you haven't done your 2024 accounting, you need to, what we would advise is to take the steps to appropriately document your allocation method, document your standing orders as applicable, and then complete your accounting as quickly as possible. Try to refrain from trading these assets during 2025 until you're able to complete your accounting and then complete your allocations. By doing that, you'll still be in compliance with this safe harbor. So again, feel free to ask questions. You can leave comments down here below on the live channel here on LinkedIn, and I'm happy to answer them. But yeah, going back to the deadline, that's really what we're looking at. Is most people are going to have to do the documentation at this point. Most people are going to have to do the documentation steps, and then they're going to have to just get their accounting complete as fast as possible so they can get into a position where they're able to allocate these costs. So, another question that I get a lot is, what are the allocation methods? And this gets sort of convoluted, so I don't want to get too much into the weeds on this. There's, two considerations within this revenue procedure. It's what allocation method are you going to use, and then what accounting method are you going to use. For the allocation methods, there's two main allocation methods, but there's a lot of variability even between those two methods. So the first method is a specific allocation, and for most people, most people are going to use the second allocation method, which is the global allocation method. With some exceptions, of course. This specific allocation method is literally just, you have to go by each tax lot and specifically allocate them. So each individual tax lot, you have to choose it and allocate it. It's much more time intensive than the other option, which would be a global allocation. So on a global allocation, so firstly, the specific one is more administratively burdensome, but you can, create overall a better tax outcome for some taxpayers, because you have full control over exactly how each tax lot is being allocated. A more streamlined approach that can still be very effective from a tax standpoint for many people is using the global allocation method. So the global allocation method has to apply the cost that, or has to assign the cost from a universal basis to the accounts following a consistent methodology. So there is some flexibility here. And what we recommend doing in terms of the methodology that you choose is somewhat driven by the accounting method that you're using. So if you're going to use FIFO going forward, and you're going to do a global allocation. That means once these assets are allocated, the first asset that came in is the first one that's going to be treated as sold. So when you're doing your global allocation, it's strategic to allocate the highest cost to the first purchase asset in each account. And that way, your historical basis is going to be optimized if you're going to do your accounting on FIFO. Um, if you're going to do specific identification and you're planning to leave standing orders for LIFO or for HIFO, something where we're optimizing for last in, first out, or highest cost, then you kind of want to flip that on its head. In that scenario, you would want to, during the global allocation, allocate the highest cost to the last purchase asset. So again, you're optimizing your historical basis. So obviously, we get a lot of questions around which one should you choose. The FIFO methodology is going to be less administratively burdensome. And as you can see with the global allocation strategy I just briefly outlined, you can optimize your historical basis from a tax perspective using a highest cost to first purchase global allocation and then applying FIFO to that account. The problem is that let's think about the next 5 years. All of your historical basis has been optimized, so that's going to be good from a tax perspective. But you may, over the next 5 years, find another asset that you want to purchase, and you purchase it at a low cost basis. And then years and years pass by, that asset's still going to get reported on a FIFO basis, and that really wouldn't optimize your tax position year over year from that perspective, because it's going to still be on FIFO, and the earlier cost in that example on a new asset that you're purchasing over several years is going to be your lowest basis in that asset. So FIFO is less administratively burdensome, and it does optimize your historical cost from a tax perspective, but it leaves room to where future purchases of new assets and new tax lots may not be fully optimized. Now, the other option is to do specific identification, and this has to be done with standing orders. Likely, you're going to do it on a LIFO basis or a HIFO basis. This is more advantageous from a long-term perspective for taxes, because going back to the FIFO example, that's only optimized for a historical cost basis, and we're able to optimize the historical cost basis for LIFO as well, just reversing the order. Where there's the potential to benefit you more on staying on the spec ID and doing something like LIFO or HIFO is in that example where you're acquiring a new asset and it grows over years. Like let's say you purchase the next Ethereum or the next Bitcoin or the next Solana, and that asset just starts at a very low basis and grows. If we have you on LIFO, this can be much more advantageous for these future tax lots that you purchase. Now, if you do choose to go this spec ID route, it's much more administratively burdensome. Starting off with the fact that this requires standing orders to be documented in non-custodial wallets and with brokers by January 1st. So that's going to be one of the additional steps that you'll have to do now before year end, is document those standing orders appropriately if you're going to go this route. So Thomas, I think that's a great question. Should we trust but verify a software provider's allocation solution, and are there pitfalls? My perspective on crypto accounting in general is to never trust any software provider. If you look in their terms and conditions, their liability is strictly limited. And when you're providing professional services as a CPA or an accountant, the burden falls on you to verify the accuracy of that to a much greater degree than it does to them. So, I obviously we need to leverage these tools, and they save us a ton of time, and I'm extremely grateful for them. But I never trust any of them. You need to leverage them, but you need to verify every piece of data that comes out of them, and you also need to make sure that you've retained that data in your long-term records as well. So yeah, I do think that there needs to be scrutiny on the ending basis, both before the allocation and after the allocation, because one thing I see is that most people don't even verify their calculated ending holdings to actual ending holdings as a due diligence step in their accounting year to year, which obviously leads to inaccuracies. And now you're going to have this added step where that basis needs to get allocated following these methodologies. So yeah, you need to scrutinize that and make sure you check it thoroughly to ensure that it's following the correct methodology, because it's not going to be an excuse to the IRS for you or your client that you're just relying on a software basically. But again, we have to use these softwares for clients at the same time due to the nature of this work. So it is something where you want to leverage these softwares, but you want to verify all of the data inputs and outputs to ensure accuracy. Let's see here. So I do appreciate that question. And for, I know more people are joining right now. To anyone that's joining, this is an AMA format. So feel free to drop questions in the chat on LinkedIn, just like Thomas just did. And I'll be happy to answer those questions for you and address anything related to this revenue procedure. Obviously, time is of the essence with this. January 1st is coming quickly. So if you haven't taken the steps to document your allocation methodology, to document your accounting methods, and potentially your standing orders as applicable, you need to be moving forward to doing that. So another question I get is how do you document your standing orders? Well, I'm still to a degree assessing that, because part of it, we need to document standing orders within non-custodial wallets. And for that, we have an internal process at Camuso CPA where, we basically have a document. We include some language in there that's dictating what the standing orders are, and then we have our client sign it. For the exchanges, there's an extra step that needs to be done, and that's where it's not totally clear, because the exchanges need to basically create a feature that you can go and log in and leave standing orders, where they're facilitating this and they're making it easy for you. I haven't really seen many exchanges roll that out as of yet. I did get an email from Gemini a couple days ago, and I haven't logged into my account on there yet, but they did state that in this just general email that I got, that they're accepting standing orders. About a month or so ago, Coinbase left comments to the IRS regarding this revenue procedure, telling them that they needed more time to be able to put these mechanisms in place. So I think a lot of exchanges are trying to catch up to this right now. So, obviously we still have this January 1st deadline now. So if you're going to be leaving standing orders and these exchanges don't have something rolled out in time, you still need to document them appropriately and reach out to the exchanges, even if it's just sending an email what we've received to their support that we have timestamped, dictating what you want your standing orders to be. So, we're watching this closely on which exchanges are going to kind of roll out something that's more streamlined and that are going to be able to facilitate this more, like Gemini. But right now, that's been the only one that I've personally seen so far. And time is ticking on that. So, we're watching it closely, and if all else fails, we will just be reaching out, having our clients reach out to them and documenting that. Let's see here. So another question I get is, why haven't I heard this from my CPA? And I think that this revenue procedure in general has kind of flew under the radar. I'm seeing more people starting to talk about it over the last like week or two, I would say, but there hasn't really been a lot of warnings to taxpayers, I would say, over the last 5 or 6 months. Usually, when I'm speaking to a group about this, and I've done several presentations on this both in person and virtually, and in virtually, in private groups and in public groups, I've explained this at this point to thousands of people. And I would say, like, the majority of the time that I've laid this all out for someone, it is the first time that they're hearing about it. And, that's obviously a huge issue because to the degree that people don't meet the requirements for this safe harbor, they're going to have accounting and tax issues in the future. So, even the AICPA released comments for the IRS maybe like a month or so ago. And one of the comments that they left was that there's not enough publicity and press releases and warnings that are going out to taxpayers to make them aware of this revenue procedure. So they were encouraging more of that, which apparently we didn't get. So I just think, taxpayers are unaware. Even accountants, I think, are playing catch up on it. I've been getting emails from accountants asking me about the revenue procedure. Even just, yesterday I got an email from another accountant that was just asking me, I just heard about this revenue procedure. I got my clients asking me about it. What are we supposed to do with it? So, yeah, I think a lot of people are just playing catch up on this, and it is a lot to digest. And in general, I think that, there's a lot of good crypto accountants that have been around for a very long time, like myself, and there's some that are just getting involved and or maybe got involved like the past year or two. And to the degree that they're in that group, there's a huge learning curve. And what this revenue procedure does is it's changing the whole way that the accounting that gets done. So it's just like a whole extra step for people to learn, basically. So, I can't say exactly why there hasn't been more information on this, but it has been somewhat limited. But the good news is if you're watching this now, that there still is time to get into compliance if you take the right steps to document everything methodically and do your allocations as soon as possible while refraining from trading in the new year. So, Thomas, you're asking, is there a definitive guide for modeling the different approaches you outlined? Importance of process and repeatability. I haven't seen anything. Everything that I've done has been like internally created models and strategies, and I put a lot of time into it because this is so new. I don't think there's a lot of resources that are out there for it. I'm even seeing like mixed bags of interpretations sometimes by people on, which global allocation method you can use, which accounting methods that you can use. So I haven't really seen anything that is standardized yet. And I think another one of the problems is that, clients are going to have to make a decision on their allocation methodology before the new year. So there's really not a lot of time at this point to model these out for people. So like if we're at a point now at Camuso CPA, if we're taking on a new client and we have to comply with the revenue procedure, obviously, and probably clean up their prior year accounting, it's unlikely that we're even going to get them a clean basis calculation. Like if we have to do several years, it's unlikely we're going to get them, a clean basis calculation in the next 10 days or with however many 11, 12 days. So it's more about, laying out these options that I've laid out. You either do FIFO accounting, highest cost to earliest purchase global allocation, or you do spec ID with standing orders for LIFO or highest cost, and then you reverse the allocation. So highest allocation goes to the last purchase. And then really what it comes down to, I think, from there is Do they just want to stick with FIFO, have more simplicity, but know that only their historical costs are optimized, and that, future assets purchased over several years at a lower basis may not be fully optimized? Or do they want to go and take on more of an administrative burden and start looking at the standing orders and applying spec ID using standing orders, basically? So, the other thing I'll point out too with that is that it's irrevocable. So, the whatever change that you're going to make to this accounting system, with the accounting method and with the global allocations, you're not going to be able to take it back or like change it year over year. So it is a very important decision, and it shouldn't be taken lightly by anyone. But I haven't seen any deep guide for modeling it, or even like consistency in approaches by firms that I've seen putting out information on it, which is interesting. Um, let's see here. So I think, those were most of the questions that I compiled beforehand. And, I appreciate the questions that everyone's asked so far. Thomas, thank you very much. If there's any other questions, drop them in the chat and I'm happy to address them now. Otherwise, I'll probably end up wrapping this up and get back to actually, working on these client engagements and working on more of this revenue procedure. So actually, Jeremy, that's a good question. I've been getting that question a lot, and I'm glad you asked it. So will all of this change with the new administration? From my perspective, no, it won't. There's going to be tons of tax changes with the new administration, but I don't necessarily think it's going to impact this or lead to what a lot of people are expecting in crypto in general. The reason I don't think it'll impact this is because this was a long time coming. The universal basis of accounting just isn't fully accurate, especially when we're considering that 1099-Ds are going to be reported on an account by account basis. And, applying HIFO on a universal basis was just never a valid approach. It was just a misinterpretation of the existing guidance. So I think this revenue procedure was a long time coming, and I do think that it's a good change that's been implemented because, and from my perspective, it's adding more clarity and more flexibility for clients to be able to apply specific identification in a way that we can be confident that it's compliant versus before, everything's just on a universal basis. Even though people were doing that, it wasn't fully compliant. So I think this actually leads to, it's more complicated, somewhat of an administrative burden initially, but I think it leads to a better tax system related to crypto, and it can actually help people optimize their taxes as well. So I don't think it'll change from that perspective. Also, these changes need to be implemented by January 1st, and we're not even going to have the new administration by January 1st. So I think that makes it more likely. And now, obviously, we've seen a lot about just generally what crypto tax is about, just having no capital gains taxes applied to cryptocurrencies, for instance. I do think we're going to see some big tax changes and tax incentives that are, focused on cryptocurrency in our industry. But I don't believe that we're just going to see like no taxes on crypto. Just we're not doing anything anymore. I think that's unlikely. What's more likely is that certain cryptocurrencies are going to have different tax exposure. Like we've seen things like where the made in America cryptos may not have capital gains. That'll apply to specific cryptos. It'll likely increase the administrative burden on your accounting and taxes. Or we've seen in other countries where they have no capital gains on BTC, but it needs to be held for more than 3 years, which again is going to to a minor degree increase the complexity with your accounting and still going to have a tax burden placed on you. So I do think that we'll see changes. I think they're going to be more in the form of different, tax incentives, but those are always going to come with strict requirements that are going to have to be met. And usually that leads to more of an administrative burden because we're going to need to track all of that from an accounting and tax standpoint. So that's kind of like my outlook on crypto tax changes in general. And as it relates to the revenue procedure, I don't anticipate that changing this, but that is just my opinion. So we'll have to wait and see. So thanks a lot for that question, Jeremy. Does anyone else, if anyone else is watching that has questions, drop them below in the chat. I'm going to hang around here a little bit, and then I'm probably going to go get back to it and, start working on more allocations for people here, getting more accounting up to date. So again, just keep in mind, January 1st, you need to have documented your allocation method. You need to document your standing orders if you're using Spec ID. And to Thomas's point, you need to be strategic in these decisions because it's going to have a large impact on your tax optimization moving forward into next year. So Thomas, yeah, concerns over 1099 DA matching when received in 26 for 2025. I definitely have concerns on that. I'm expecting that we're going to have a lot of clients with mismatches. We see that just with other tax reporting that we get with crypto now. So I think that this is going to be a very big undertaking for exchanges to report these 1099 DAs. So yeah, I am expecting discrepancies, and the only thing that we can do really to address that is to accurately do the accounting and then to be methodical in our reconciliations between our accounting and what's being reported by the 1099 DAs. And, to the degree that they're inaccurate, we'll have to make adjustments to them. But yeah, I am concerned that we're going to see a bunch of matching issues and discrepancies associated with this, even for clients that are transitioning to the account-based. So yeah, these have been really great questions so far. I appreciate it, everybody. If there's any more, drop them in the chat below. I'm happy to go over them here. So the last thing I'll say, and again, if more questions come in, I'll address them. But something else I'll point out is that obviously at Camuso CPA, we are working closely with clients on this. We have been researching this since it came out, advising clients on it since it came out, and warning the whole industry since it came out. So, if you need assistance with this, if you need to get your accounting up to date, if you need to do the allocations, if you need to understand your options regarding your allocation method selections and your accounting method selections, if you need assistance with the documentation, that's what we're helping clients with. And, I'd be happy to sit down and have that discussion with you about your portfolio or your business and see how we can assist with this. So Rudy's asking, what's the best way to determine cost basis if a crypto was received as an investment into an X-Man wallet and not purchased? Showing the price at transfer, so we assume what we have documented in terms of cost basis, but we accept it into a private wallet. And so yeah, you're saying what is the best way to determine if the crypto was received as an investment? You either like did a cash outlay or a crypto outlay for it, and then you received it, so you'd apply the cost basis based off of whatever the value is that you exchanged for that asset. If you just received it as like an airdrop or as income, you would just treat it as income, and then that would set your cost basis into it, and then that cost basis would carry over. Yeah, Thomas, I saw that too with Coinbase. I don't think that was, unless I'm wrong, because the stuff's getting updated. I did see something in there with selecting a cost basis, but I don't think it was related to standing orders. It seems more like it was related to the calculations that they do. But yeah, that part, that's not totally clear to me. I think they're gonna have to update that more and make it more clear for people. And I agree, it's a minefield. There's going to be, tons of compliance issues that start to come up with the reporting coming from these exchanges. Hopefully it'll get better over time, but I agree. There's going to be a lot of mismatches and discrepancies that are going to have to be addressed. Well, okay, so we're coming up on about 45 minutes here. I hope I covered some information that can benefit you. I know that this information is extremely time sensitive and it can benefit anyone that's holding crypto. So I hope that's you, and I hope that you've taken away the steps that you need to take before year end to really get into compliance with this. If you need assistance with this, feel free to contact me and my team at camusocpa.com or reach out to me directly on LinkedIn. We can schedule a consultation and discuss your portfolio or your business, and we can assist with all of your accounting needs and all of the tax and accounting needs related to the considerations for this revenue procedure. The last thing I'll leave you with is keep in mind the time sensitivity to this. We have to have this completed by January 1st. Thomas, thank you as well. I really appreciate it. I appreciate the questions and the viewership and the support. So again, everyone feel free to reach out to me. I'm happy to speak on this more directly, individually. Until next time, I'm Patrick Camuso, signing off.